Good morning, everyone. Thank you for joining in. Today, we'll be talking about Nifty 50 and what's happening globally and how that impacts Nifty 50. And where is India's correction when compared to the other global markets, right? In just the last 1 week, India fell by almost 3.2, 3.3%. And this is in line with the other Asian countries, which is also bearing the brunt of the Middle East war. And even before the Middle East war, India has been falling, as seen in the percentage change 6 months or percentage change year to date. So it's not like the war is a trigger, and we'll talk about that too in this webinar today. So this is the flows from FIIs, DIIs, and within DIIs, mutual funds. Mutual funds is a subset of DIIs. What has been the flows in the cash market, right? And so far in calendar year uh, 2026, almost $13 billion have been sold by the FPIs, including both the primary and secondary. Primary is the IPO market. And this is very alarming because calendar year 2025, the entire year, the outflows were 18, almost $19 billion. Here in just 3 months, we've seen almost $13 billion of outflows versus 24 billion by DAIs. And within this 24, 14 billion has come from mutual funds. So the selling has been driven by the FIIs. And this is one of the highest in the recent few years, except for maybe the Russia-Ukraine war in 2022. But if this outflows continue, this will exceed 2022 also. And this is higher than even the 2008 crisis, the global financial crisis, where almost $13 billion went out of India. India is not the only loser here. There are other losers. For example, if you see South Korea, they've already lost $30 billion, and Taiwan, very similar to India, at almost $13 billion. In fact, February they saw an inflow of $8 billion because the funds were chasing TSMC, Taiwan Semiconductor Corporation, which is the fabrication powerhouse for semiconductor chips. But the Middle East war affects everyone, so everyone has seen outflows, some less, some relatively higher, like India and Brazil is kind of is it the geographical location is also very important here, where Brazil is not anywhere close to the Middle East, and they don't depend on Middle East for at least majorly for the imports. The risk here is that there is no upside to where oil can go, and there's no cap on oil. And there's a slide from Goldman Sachs which says that based on how long the war lasts, whether base case is 6 weeks, adverse is 10 weeks, severely adverse is when the war is also delayed or elongated, and there is a hit to the production. So far, no one has cut their production yet, right? So it's only the flows that has got affected. So severely adverse situation is when even the production will get affected. So in such a scenario, even in 2027, right? So this is 2026. Even during 2027, in all of the scenarios, we are not going back to the pre-war prices of $60 or even $70, right? So we'll settle somewhere at $80 is the current market estimate. In case of let me share again. So in case of war extending at least by another 5 weeks, which is all of April, because base case is 6 weeks, basically 4 weeks of March and another 2 weeks in April. But let's say if all of April also, right, it gets affected by the war, or the war gets elongated, then we are looking at almost $100, close to 95, $100 of oil prices in the next 2 calendar years. almost because 2028 also will be slightly affected because so almost 18 months of high oil prices we are looking at. And why are these Asian countries falling the most? Because Asia is heavily dependent on Middle East and energy in general. So this is the energy trade balance as a percentage of GDP. So India almost imports 3% of its GDP. Right, that's a huge number because given oil prices are going up by 60% already, right? So 60% of 3%, right? That could be the impact that we are looking at. Of course, we'll mitigate some of it, and it will not be for the entire period. But that's the impact that this war can have on our GDP growth. Gas reserves across Asia, again, another way to look at it, right? Malaysia is a net exporter, but if we look at India, we just have close to 30 days of consumption for our gas reserves, right? That's just 1 month. And some have slightly higher. China has at 50 days of reserves. So by the end of March, right? So the war started on Feb 28. So by the end of March, we would have already lost our reserves. But in the last few days, we did get some of the shipments after Iran allowed certain tankers to pass through. So, but this is an evolving scenario, right? So if the war continues to last longer, then we'll run out, not just us, all of these Asian countries will run out of reserves sooner. So how much just to quantify the imports, right? We'll take the three major energy sources, LNG, LPG, and oil, and we are dependent anywhere from 50% to 87% on imports. And within that, the share of the Strait of Hormuz, the imports via Strait of Hormuz is 29% for LNG, 61% for LPG, and 47% for oil. So almost half of our oil is flowing through Strait of Hormuz, and that's currently being blocked. But the good part is the inventory days is kind of higher for oil and LPG. But this we would have run out of LPG by now, if not for the recent tankers that we received. Oil we might still have 10 days, 15 days, or even 20 days, depending on the recent tanker arrivals. That's the kind of risk that we are looking at. And this is just India. If you take the world as one piece, then almost 8 to 13% of the energy flows through Strait of Hormuz. So what it does for India's macro is that our basically our current account balance will shoot up in a big way. Right. So if you take oil at $100, our current account balance, which is zero point 0.6 in 2025, FY25, and expected to be 1% in FY26, will inch up to 2.5%, almost 2.5 times, if oil is at $100 for entire 2027 period. In other words, so this is a favorable scenario. In March, we're currently here. 1% is the current account deficit. That will jump up to 2.5% if the war extends till mid-May. And that means $82 billion is the balance of payments. And INR, we've already touched 97. It can go up until 98 in this case. And our center's fiscal discipline also will take a hit. CPI inflation will also take a hit. We'll see that in a bit. And like already discussed, given 3% is our energy dependence, trade balance, and 60% hit to 3% is 1.8. Let's say we impact some of it. So GDP can compress by 1 percentage point even in a normal scenario, base scenario. And given inflation, liquidity will get tightened eventually. So this is the what. So we are seeing the light aqua line here, which is the market rate of USD INR. Then there is something called as real effective interest rate, REER, which is based on trade weighted averages that we have with 40 other currencies. And throughout the post-COVID period, so 100 is the baseline for REER. Some issues with the presentation. Hope it's visible now. The screen is visible now. All right. So, throughout the post-COVID period, INR has been very expensive, right? Overvalued, in fact, and that has corrected recently, right? And we'll see how much INR has to correct for to get the balance in the trades. This is a slide from Axis where they're saying that if oil price stays at $100 for 1 year, and INR has to correct by at least 7% to rebalance the trade, negative trade that we have in energy, right? And that's already played out to some extent, where you can see that from a peak of almost close to 107, 108 RER, it's now down to 96, 95, right? And that's all. That correction has already played out. Probably we might have some more correction in depreciation in the INR, but I think we are most of it is done. This is assuming oil will stay at $90, $100, right? So any further increase in oil, there will be further depreciation in rupee. So that's a double whammy to India. One, INR is becoming cheap in real terms, and our current account deficit is widening. That means we need more. So to buy more oil, right? So we'll need more US dollars to buy the oil. Because in value terms, even though the volume will remain the same, the value term oil buying will increase significantly post the jump in oil prices. So the combined effect is a sustained INR depreciation cycle. FII outflows, like we already discussed. So this is the highest ever FII outflows that we have seen. And from the current recent peak of Nifty, which happened in September 24, up until March 26, FIIs cumulatively have sold $42 billion, and that's almost 1.1% of the market cap of India, the total market cap of India. And to historically, or at least based on data, right? So for every 1% volume, there is a change of 5 to 10% in the price of any instrument, right? If an instrument sees 1% volume inflows or outflows, the change in the price of that instrument can be anywhere from 5 to 10x, depending on the seriousness of the seller or the buyer, right? So this 1.1 could have to some extent been cushioned by the DAI flows, but this is the sole reason for Nifty's correction from the September 2024 peak. Again, why did FIIs sell? It's because of the revisions in the India's EPS, earnings per share calculation. And if you see that dark blue is FII flows, light blue is EPS revision, right? And that has been very linear in terms of correlation. The higher the EPS revision, the higher the flows by FII, outflows by FII. So in the last 12 months, right, this is as of March, India has seen minus 12% change in its EPS estimates. And that's only second worst to Vietnam. Everyone else has a better, in fact, some of the countries, for example, Taiwan, Korea, driven by AI, right, they have seen positive EPS changes, and that's why flows were moving towards those Asian countries. And India has seen a minus 12% change in its EPS. So this is the NSE is 200, which is where FIs predominantly operate. So the EPS growth for NSE 200 has hit a peak of almost 18.5% was the street estimate, and now that's down to 11%. And we've already done with 3 months and 3 quarters of FY26 with just 1 quarter to go. So that's from a peak of 18% EPS growth. We are now down looking at 11% EPS growth for FY26. And this is not one-off, because every global oil shock has resulted in India's EPS being revised down, right? So be it the 2011 Libyan civil war, be it the 2012 Europe's oil embargo on Iran, and the more recent Russian war against Ukraine. In all these cases, India's EPS was revised down. In most of the cases, it was almost 7-8% in the 2011 when oil hit the peaks of 120, 150, or close to 150, right? So the EPS was revised by almost 13% in a period of 12 months. 6 to 13% is the range in the last three global oil shocks. And this is an estimate from the government, CEIC body. where if oil stays at 100 or even lower, the base case is 4.3% inflation from the current almost 3% inflation, right? And if it's an adverse scenario where the war is delayed by another month, and that can result in more higher inflation of almost 1 percentage point. So we'll go from 4.3 to 5.5. That's the inflation sensitivity in terms of energy. Again, another way to look at the chart, if oil price stays at $150 for 1 year, right, we are looking at 7% inflation, right? We haven't seen this in a long time, 7% inflation. And of course, the first ones to react will be the GSEC yields, India's yields, where we started somewhere close to 5.7% in the month of February. And now we are looking at almost 6.2% in the short term, the 2 year yields. The 15 year, the 10 year are kind of stable, but they still saw a 10, 20 bips increase. But the major increase came from short term yields. So 50 bips increase basically means the market is already pricing in a 50 bips rate hike. Of course, RBI will do it or not do it, that's a different scenario, but market is pricing in a 50 bips rate hike. And what happens when crude prices go up? This is a historical study by Bernstein, where some sectors have very high correlation to crude prices going up significantly. For example, paints, aviation, staples, cement. We'll look at each of them. And that's already seen in the Indian markets. It's a sectoral breakup for 1 week and 1 month. You can see that private banks, financial services have taken a hit. FMCG has also taken a hit. Whereas the export-focused sectors like pharma and IT are relatively stable. IT, of course, for other reasons, it was already cheap when the war started, but pharma is holding up very well in the last 1 week and as well as 1 month. So why is life insurance falling? It has got nothing to do with fundamentals. It is purely based on FII selling, but a rate hike will impact fundamentals. And this is a sensitivity slide from HDFC Life, where every 1% increase in the interest rates, right, that will change its CV by 2.5%. And it will decrease its VNB margins by 1.2%. So the rate hike going up will impact life insurance companies, but the reason for the fall is FII selling. Paints, around 300 to 400 ingredients are used in the manufacturing of paints, of which TiO2, titanium dioxide, constitutes around 20-25%. Another major raw material is vinyl acetate monomer, VAM or VAE. So both these and few other derivatives account for almost 40 to 50% of raw materials used by paint companies. So therefore, the fluctuation and the volatility in prices of crude will directly impact paint prices. And we are a net importer of TiO2. We don't have enough production of TiO2 in India. Airlines, this is fairly straightforward, right? The air fuel is directly linked to crude oil prices. And as a percentage of the total cost for the airline industry, the fuel accounts for almost one third, and to some extent till 40% of the total cost. And for every 10% increase in ATF prices, EBITDA hit is 15%. Cement, this is more short-term in nature because they're not directly imported, only to some extent. For example, they import pet coke and coal for their fuel. Basically, they have to heat. They use a lot of heat in their manufacturing process, and they also use polypropylene, which is a raw material used in the cement bags. So every 10% increase in pet coke and imported coal will impact their EBITDA by 8%. In absolute terms, overall impact will be 130 rupees per ton. Say, for example, Ultratech and all operates at a band of 1,000 to 1,500 rupees per ton. For them, the impact will be 130 rupees per ton in Q1 of FY27. FMCG, again, different for different FMCG companies. For example, for Tata Consumer Products, which is a Nifty 50 company, is more exposed because they have lower inventory, and packaging is almost 20% of their raw material cost. And even for HUL, the soaps they make are sensitive to palm oil. while detergents are exposed to a chemical called linear alkyl benzene, which is a crude derivative, right? So, Capital estimates that if crude stays at $100 per barrel, right? So this will be the margin impact for the FMCG companies, almost 5 to 6% margin impact, right? So 3% hike will be required in the products if oil is at $85, but a 5 to 6% increase will be needed if crude is $100 per barrel. Please note that the Brent crude is already above 100. It did fall below 100 once Trump announced negotiation and ceasefire, but oil is now back above $100. And if the war extends, it will only go up further from here. Auto, not direct impact. One is through, they'll face impact through rubber. So all the tire manufacturers use crude derivatives like synthetic rubber, carbon black for manufacturing tire. But even natural rubber prices have been going up. And both of these put together, for example, tire cost as a percentage of the car will somewhere be 2% or max 3%, right? So to that extent, OEMs will face margin pressure. The other impact is through forging and casting companies, which use a lot of gas-fired furnaces to heat up their furnaces because you have to melt metal in forging and casting. So, for example, I spoke to some of the Daimler employees, and they say that they're trying to find new vendors, right? So their existing vendors, if they don't have capacity, they're trying to onboard new vendors who will have some kind of inventory left with them. So our positioning in True Blue, which is a large cap pure Nifty 50 product, there going forward, our positioning will be overweight BFSI, banking and financial services. Will continue to be overweight in all the export related plays, which is auto, pharma will be equal weight, FMCG, and we continue to be underweight in IT. We'll see each of these. So banking for the last 2 3 years, or even for major part of post-COVID, the credit growth was always driven by the retail credit. But if you see in the last few months, this is Jan 26 data, where the industry credit growth has touched double digits of almost 12%, and driven by micro and small and even to some extent medium. But another good part is large is also starting to grow from a weak base of 1% credit growth in June. Now it's up almost 5 6%. And within banks also, there are few which are continuing to grow faster than the overall sector itself. For example, if you see corporate, Kotak is growing at 17 18%. Axis is growing even higher than Kotak at 20%. SBI, they're saying that they have a huge pipeline of corporate credit waiting in their to be dispersed out. So they are growing at 13% in corporate. So all of this leads to points at least to the direction where corporate capex might pick up going forward. Retail anyway has been very strong for some of the banks. ICICI is saying is they are being cautious in retail because of over leverage post COVID. So this is where BFSI is at. We are looking at almost 15% growth for the entire sector, and some banks within this will grow faster than the sector. Paints, we like Asian paints at these prices because of one very interesting factor. This was in the previous cycle. Whenever there's been material inflation in oil and crude, their gross margins will go down for the next few quarters. For example, from a peak of 43%, it did go down to 35. Then the Russia-Ukraine war happened. Then it went back to 35, and now it's at 43%. And they have been able to maintain this 43 44% gross margins even till date. So now in the next 2 quarters, they might again take a hit. But there, once the pricing has been passed on, right, they're not cutting prices. This is the best part about FMCG and paint companies, right? They maintain the prices and they don't cut the prices once the situation normalizes. So they can continue to maintain 44% gross margins once they have passed on all the recent crude oil price hikes. Auto, so INR is weakening, rupee is weakening, and which means we'll become very competitive in the export market. That will boost exports. So Maruti and Bajaj Auto, they give us exposure to export portfolio, and Maruti thesis is very simple, where the company is talking about going from 2.4 million cars per annum to a production capacity of almost 4 million cars by 2029. And the realization today, it started a few years ago, it was 5-6 lakhs per car. Now it's roughly about 7 to 7.2 lakhs per car. That can inch up to 10-12 lakhs per car as and when they sell more compact SUVs and SUVs. And within the EV space, we prefer M&M to Tata. Pharma, again, very similar to auto, where because of INR weakening, it boosts export competitiveness for Indian pharma companies. And there are multiple drivers. For example, GLP-1, which is went off patent this month in India, is expected to drive business for at least for Reddy's, because although India market is going to be very competitive, with almost 10 players have already launched, another 10 players are expected to get approval in June, May or June. So another second wave of launches will also be coming in India, but Canada is a relatively has a weaker competition, and in fact, their Reddy's is the first to file. They'll be the first to launch in Canada whenever they get approval. Sun Pharma has a bit of innovative products in their pipeline that will drive their growth in the US and India as well. And Reddy's is also a bet on biosimilar patent cliff. So there's a list of biosimilars that are expected to go off patent in the next 2-3 years. Starting, I think there's a message. I'll pick up these questions towards the end, sir. So Reddy is just one of the very few players which is working on a biosimilar called abatacept. Abatacept is a almost $1 billion, more than $1 billion market, and no one is even working on a generic right now except for Reddy's. So Reddy's will gain a lot of these market share and a lot of these biosimilars that are going off patent. And FMCG, we've always liked FMCG even before the war started. Now, because of the FII selling in FMCG, we're getting better prices, better valuation, and we already saw GST cuts, income tax cuts, pay commission hikes that are expected in 2027. We expect these three to drive FMCG consumption going forward. IT, so we are still in a wait and watch mode, right? So this is a very tricky scenario where we don't know if deal compression will happen first, and then services will expand as AI adoption by enterprises is taking time, or will they happen parallelly? Deal compression will also happen, and but AI-led demand also will come for these eight. So we don't know if both will happen parallelly or deal compression will happen first, and then AI-led demand will come back. So we are in a wait and watch mode. It is better to play beneficiaries rather than playing IT companies. For example, banking will benefit a lot from AI services or AI agents. But there are drivers for IT, which is one is the largest piece of all, which nobody is talking about, is the labor automation piece, where today the labor market, all manpower related market globally is $50-60 trillion. And of that, one of the private equity estimates is that at least $3 trillion of that can be automated via agentic AI, right? And all of these will need service companies to implement these agentic AIs for enterprises. So this is one driver going forward, but we don't know when this will start because it depends on enterprises adopting AI. The other is the application modernization layer. This is a slide from Investec, where they're saying that there are 200 billion lines of COBOL code. And all of these COBOL programmers, the average age of these programmers is 55 years. They're close to retirement, right? So all of these have to be modernized either to Java or Python or any of the latest programming languages. This is the second driver, and third driver is data and governance. This is a snippet from Coforge saying that governance is more important, and AI will increase the need for governance because the applications will widen significantly, and that means there will be a lot of change management that will be needed, governance, compliance, risk, all of that has to be taken care. And the enterprises don't have the ability to maintain this, so they need someone for them to do these AI implementation. This is a very good slide from Infosys Investor Day, where they're saying that although 92 million jobs will be displaced, but there will be almost 170 million new jobs created in the form of forward deployed engineers. So the risk is, will 92 going away and 170 million coming in, will it happen parallelly, or will there be a gap between these two happening? And there could be continuous more derating in the IT stocks because of this. But having said all this, Nifty 50 valuations are very reasonable now because of the correction. Now we are down below the one standard deviation and more closer towards the mean. But please note that this mean that is calculated in this chart is for the 25-year period since 2000. If you take the more recent mean, I think 20x will be the mean PE for Nifty 50 in the last 10-15 years. So we are more closer to the 10-year average than the 25-year average. But more important than PE is the price to book, because price to book is directly linked to your ROE. For a 15% ROE, which is what Nifty 50's ROE today is, right? So 2.5 times is fair price to book, and we are close to roughly about 2.6, 2.7. So we are very reasonable in terms of valuation. And today, Street is estimating almost 17% growth in FY27. Of course, given how sell side works, this 17% growth will only be downgraded because Q1 will be a washout for a lot of companies, right? So this will be downgraded. But if you look at 1 year forward, right, so FY28 will be more normalized, and double-digit earnings growth is still looks a fair possibility in FY28. So summary, sustained volatility has the potential to set back the growth, and we've already seen that 60% jump in 3% energy import would mean 1.8% impact to the GDP, but we'll do mitigation of that, and we'll do other measures to reduce that. So the GDP impact can be as high as 1% slowdown, right? Like from today, market estimate is 7% GDP growth. We might well be looking at 6% GDP growth for FY27. Basically, this is effectively cut down what the government has been trying to do in the last few quarters through various measures, right? Income tax cuts, GST cuts, right? So they've been boosting growth. They've been cutting down the strict measures that they had given banks, and the credit growth was just starting to tick up, and then we have hit with the war. So it's a very dynamic situations, but we find valuations very reasonable, so we continue to invest, and we feel that this is one of the best times to invest in the last 5 years since COVID. This is True Blue's performance. Of course, it is not what we were expecting. This is a function of a lot of things, FII selling and us not being present in certain volatile sectors like metals, energy, power. And all of that has contributed to us being in line with the market over a 2, 3, 4 year period. Terms for True Blue minimum 50 lakhs is a SEBI mandate, and we have an option of 0% fixed fee as well as a 1%. 0% fixed fee with performance fees, as well as a 1% fixed fee option for investors. Reach out to us. Thank you and have a good weekend.